Welcome to our ninth topic in this course, which is a discussion of money and banking. Please read Chapter 9 in the book. To broadly recap so far, we have explored three key statistics in macroeconomics. We have looked at measuring trends and cycles. We have tied theoretical goals to policy objectives, and shown how gap models, such as the aggregate demand and aggregate supply model, tie those theoretical and actual concepts together into a story-based paradigm. In this lecture, you will learn about the special role that money and the financial system play together. As background, question 275 in Chapter 9 highlights that the role of money in the economy was not always considered important in the early economic theories. Alfred Marshall was credited with beginning to integrate money into theories of the economy in the early 1900s. Marshall's view was that money was a, quote, convenient means of measuring human motive on a large scale, unquote, whether or not it was directly linked to economic activity. Of course, today's economic theories provide a central role for money. Ahead we will investigate what money is, and how it is changing and its role in the economy. In this topic you will learn 1. About the three functions of money, conceptually. 2. Whether or not credit or debit cards are money. 3. Whether or not cryptocurrencies are money. 4. What central bank digital currency is. 5. How the central bank defines measures of money. 6. Understand the importance of the money supply for the macroeconomy today. 7. How banks operate. 8. About the growth and role of the non-bank financial intermediation sector. 9. How the banking system creates money through fractional reserves. Let's begin this journey. Our starting point is to ask, what is the importance of money in economic theory? As noted just a moment ago in the introduction to this topic, Alfred Marshall offered a reason to integrate money into economic theory. Marshall's perspective was that money was a convenient way to measure aggregate behavior. But money and the cost of money to borrow it has become much more of a motivation for economic activity and, today, is appropriately linked to creating economic growth and cycles. But, what exactly is money? Well, economists define money as any asset that is generally accepted in payment for goods and services, or in the repayment of debts and has legal status granted by a government. Money conceptually serves three functions. 1. It serves as a medium of exchange. 2. It serves as a unit of account. And 3. It serves as a store of value. Let's explore each of these functions. Why is money a medium of exchange? Money as a medium of exchange, or means of payment, simply means it is an efficient way for people to trade. It minimizes the transaction costs of exchange. If money did not exist, people would have to barter, that is, exchange physical goods. Okay, this should make sense that economies need some convenient way to transact commerce. Why is money a unit of account? Money as a unit of account means it is a convenient way to measure the value of goods and services. Money standardizes that relationship. Okay, this too should make sense in that it provides an easy and standardized way of accounting for value of goods and services. Why is money a store of value? Money as a store of value means that money holds its value over time. Of course, money is not the only financial asset that is a store of value, but this function of money allows buyers and sellers to transfer purchasing power from today to tomorrow, or next week, or whenever, through the medium of money. Hold on. You may be thinking, how can economists say that money holds value over time when inflation reduces its value over time? That may be true. However, in the abstract, with no inflation, $1 is still worth $1. Inflation is not a consequence of what money is, but is a consequence of actions by government and the central bank. So, how are those three functions of money related? In a speech on the future of money, in 2018 by then Bank of England Governor Mark Carney, he pointed out that there is a hierarchy among those functions of money and used the graphic on this slide to demonstrate his point. That hierarchy is that money first is a unit of account, and then additionally takes on the role as a medium of exchange, and these two functions then are encompassed in money's function as a store of value. Carney noted that money is a social convention that is accepted and used by other members of society. Moreover, Carney opined that money can be made of metal, polymer or code as long as it encompasses all of those functions of money. We will see, in a moment, that Carney and most other central banks officials tend to distinguish money from cryptocurrencies based on this rationale. Although this may be a bit of trivia, how did the U.S. currency get named? The history of the term dollar for the U.S. currency goes back to January 28, 1791. On that date, the Secretary of the Treasury Alexander Hamilton submitted the final version of the report on the establishment of a mint to Congress, as ordered by the U.S. House of Representatives. In the report, the Secretary of Treasury determined that the United States national currency would be called the dollar, and he accepted Thomas Jefferson's suggestion that the unit should be expressed in decimals. While this just may be an historical note, it also points out that currencies are simply a tool for commerce created by the government, and the government can change or recreate the currency it chooses to use. For example, in February 1971, the United Kingdom decimalized its currency. Prior to that decimal day, the British currency, which is the pound, was divided into 20 shillings, of which each shilling was made up of 12 pence, for a total of 240 pence to a pound. Today, a pound is worth 100 pence. But there are other examples, where a country may designate another country's currency, instead of its own creation, as its own official currency, such as Panama, Ecuador, and El Salvador using the US dollar as its official currency. In 1904, Panama's currency, which is the Balboa, was tied to the US dollar 1-for-1, but the country uses the US dollar as its own legal currency. In January 2000, Ecuador dropped the use of its Sucre currency for the US dollar. In January 2001, El Salvador jettisoned its currency the colón, which was its official currency since 1892, and officially embraced the US dollar as its currency. Also, witness the so far unsuccess push in Argentina by its new president Javier Milei to dollarize the Argentine economy. Of course, some countries use a common currency based on a monetary union, such as the use of the euro among 19 European countries. Some African and Caribbean countries also have monetary unions and use a common currency. So, money is a creation of government, whether it is own currency or embracing another country's or monetary union's currency. Is a credit card money? No. A credit card is a method to move money and is not money, per se. A credit card immediately transfers money from the credit card company's checking account to the seller, and at the end of the month the user owes the money to the credit card company. Effectively, a credit card is a short-term loan. Is a debit card money? No. A debit card is similar to a check, which is an instruction to the user's bank to transfer money directly from the debit card holder's bank account to the seller. Is a prepaid card money? By now, hopefully, you are understanding the point. Here too, the answer is no. A prepaid card stores a certain amount of money on the card, which can be used to make purchases. This is simply a way to move money and not money, per se. Now, it may get a bit more difficult to answer the next question: are cryptocurrencies, such as Bitcoin, money? What do you think? Most central bankers and economists agree with the former BOE and BOC Governor Mark Carney's assessment that it is not money, because cryptocurrencies are 1. Poor short-term stores of value, and 2. Not an effective medium of exchange. The value of cryptocurrencies tends to be very volatile and not everyone will accept them. The IMF also notes that a country's currency must have one additional characteristic to function as money. The IMF opined that it has to be legal tender, which means the government sanctions its use for commerce. However, with that said, El Salvador, in 2021, became the first country to adopt Bitcoin as one of its national currencies. The IMF, however, was against that move for reasons noted by Mark Carney. One popular form of cryptocurrency is the stablecoin, which is structured to reduce the market volatility that is common in other forms of crypto such as the Bitcoin. Stablecoins are a form of cryptocurrency whose value is pegged to a currency, commodity, or financial instrument. One type of stablecoin is backed by US dollar deposits at banks and pegged to the US dollar. There are several stablecoins that do this. One such stablecoin is the Gemini dollar, which a US dollar-backed stablecoin, that is, a digital representation of cash that can be used to interact with the crypto economy. The company says that the Gemini dollar combines the creditworthiness and price stability of the US dollar with the speed and efficiency of cryptocurrency. On the surface, therefore, it is structured to serve as a store of value. Yet, an evaluation of stablecoins by the Federal Reserve, in its April 2024 Financial Stability Report, even warned that stablecoins remain structurally vulnerable to runs and lack a comprehensive prudential regulatory framework. So, these private sector cryptocurrencies may be trying to function as money, but have some major hurdles to overcome. We will see, however, that central banks are exploring their own cryptocurrency offerings, which may change the game in the future. Let's discuss what is meant by legal tender a bit more, especially for the United States. Legal tender is any lawful form of money that cannot be refused in payment of debt. In the United States, the Coinage Act of 1965 specifies that United States coins and currency, including Federal Reserve notes and circulating notes of Federal Reserve banks and national banks, are legal tender for all debts, public charges, taxes, and dues. However, the legal authority of the Federal Reserve to issue legal tender notes has existed since 1933. The governmental authority to issue legal tender notes has not generally been available to a central bank at its founding, according to the IMF. This chart provides an overview for some of the key economies' central banks when their currency began legal tender. Some of the importance of this status of legal tender in the United States is tied to the use of foreign currencies as money in the early days of the nation. Indeed, with the passage of the Coinage Act of 1792, Congress attempted to phase out the use of foreign currency in the nation. However, the legislation also guaranteed Mexican coins the status of legal tender throughout the United States and its territories for 3 more years until 1795, when it was expected that the U.S. Mint would be able to produce its own coins to replace the Mexican ones. However, that goal was too optimistic, and the U.S. Mint was not producing enough coins to meet the domestic demand, and, as a result, Congress allowed Mexican coins to be used in the United States, per acts of Congress passed in 1806, 1816, 1819, 1823, 1827, and 1834. Even as late as the 1840s, 1 in every 4 coins circulating in the United States that was used in everyday transactions was a Mexican coin, known as the Ocho Reales. It was not until February 21, 1857, that President Franklin Pierce signed into law the Coinage Act of 1857, which stripped all foreign coins of their legal tender status in the United States. However, the U.S. currency was not officially given legal tender status until 1933, which was long after many European nations granted that status to their currencies. Okay, we have discussed the creation of the U.S. currency and the functions of it as money. Now, let's get more macro and discuss What is the money supply of a nation? The general definition of a money supply of a country is a group of safe assets that households and businesses can use to make payments or to hold as short-term investments. This typically would include cash and balances in bank accounts. The money supply, historically, has defined in terms of its relationship with economic activity. We just noted that historically the Federal Reserve defined the money supply based on assets that had a relationship with economic activity, even though the Austrian school economists were generally critical of that approach. So, what is the recent relationship of the money supply and economic activity? As opined by the Federal Reserve, over recent decades, the relationships between various measures of the money supply and variables such as GDP growth and inflation in the United States have been quite unstable. As a result, the importance of the money supply as a guide for the conduct of monetary policy in the United States has diminished over time. As the relationship between the money supply and economic activity diminished, the central bank shifted directly to interest rate targets, rather than money supply targets as its policy approach. This has been the experience in other major industrialized countries, as well. Nonetheless, money supply measures still exist, and we will discuss them shortly. But their use and interest by economists have generally weakened. Why did the money supply relationship with economic activity change? The typical explanation for why the money supply and economic activity relationship has changed over time has been attributed to financial innovations. Under this moniker of financial innovations, are lots of changes depending on how far one wants to look back in time. Among the changes are the rise of the non-financial banking intermediation sector, such as hedge funds, private equity, etc., new financial instruments, evolving financial technology that has spanned everything from online banking to more sophisticated money management systems, and much more. What money supply measures exist for the United States? Today, the Federal Reserve defines M1 and M2 as its primary measures of the U.S. money stock. M1 supply of money, as shown on this slide, includes 1. Currency, that is, currency consists of Federal Reserve notes and coin outside the U.S. Treasury, Federal Reserve banks, and the vaults of depository institutions. 2. Demand deposits, that is, checkable deposits in banks that are available to the customer by making a cash withdrawal or writing a check, physical or electronic through a debit card. 3. Other liquid deposits, that is, savings deposits plus other checkable deposits. You may be wondering why that measure of the money stock shot up beginning in 2019. However, we will defer that discussion for the moment. The second measure of the money supply is M2 and includes 1. All of the M1 components. 2. Small denomination time deposits, that is, these deposits are those issued in amounts of less than $100,000. Individual retirement account, IRA, and KEO account balances at depository institutions are subtracted from small denomination time deposits. 3. Retail money market funds, that is, IRA and KEO account balances at money market funds are subtracted from retail money market funds. Here too you will observe that M2 growth turned up faster in 2019. You don't have to remember too much about the components of M1 and M2, other than these components are how the Federal Reserve today defines its money supply measures. Over time, those definitions have evolved, which leads to the next question. Why do different countries define their money supply aggregates differently? The answer is that money supply measure definitions are dependent on a country's financial system, which means that the money stock definitions are different in different countries. The United Kingdom, for example, has an M0 and an M4 measure. In Japan, there are 4 money stock metrics, M1, M2, M3, and L. L is broadly defined liquidity. There is one other measure of money supply, which is known as the monetary base. In the UK, that measure is dubbed the M0, or in the European Central Bank that is M1, which comprises currency in circulation and overnight deposits. In the United States, the monetary base, which is sometimes referred to as high-powered money, is comprised of highly liquid funds, including notes, coinage and current bank deposits. When the Federal Reserve creates new funds to purchase bonds from commercial banks, the banks see an increase in their holdings, which causes the monetary base to expand, and vice versa. The monetary base is called high-powered money, because the Fed exercises complete and direct control over it, through open market operations, and through its extension of discount loans to banks. The monetary base, designated as MB, equals the total reserves in the banking system, which is designated as R, plus currency in circulation, which is designated as C, that is, MB equals R plus C. The graph on this slide shows the monetary base growth bubbling up in the 2008 global financial crisis and the 2019 COVID pandemic when the Federal Reserve expanded the monetary base through its quantitative easing episodes to flood the financial system with liquidity. Why does the central bank only control the monetary base and not all monetary aggregates? Depositors and banks themselves have direct influence and control over parts of the monetary aggregates, such as M1 and M2. Depositors will determine how much currency they wish to hold, which is a component of M1, for example. The depositors and banks will determine how much reserves are available to be loaned out, as well. These players will determine the money supply along with the central bank. However, the monetary base is controlled by the central bank alone. What does financial intermediation mean? The term financial intermediation means a financial institution, which operates as an intermediary or middleman, that obtains funds from lenders, that is, deposits, and provides funds to borrowers, which are loans. That is what your typical commercial bank does. What types of financial intermediaries exist? Generally, there are three types. 1. Depository institutions, which are deposit-taking institutions that accept and manage deposits and make loans, including commercial banks, credit unions, savings and loans, and mortgage loan companies. 2. Contractual institutions, which are insurance companies, also known as risk-pooling institutions, pension funds, and money market funds. The last two are also known as contractual savings institutions. 3. Investment institutions, which are investment banks, underwriters, and brokerage firms. Contractual and investment institutions have become known as the non-bank financial intermediation, NBFI, sector. Given the different types of financial institutions, does this suggest different conceptual risks of money based on the holder? Yes, according to the U.S. Federal Reserve, which distinguishes three types of money by the holder, listed here from least to most risk. 1. Central bank money is a liability of the central bank. In the United States, central bank money comes in the form of physical currency issued by the Federal Reserve, and digital balances held by commercial banks at the Federal Reserve. 2. Commercial bank money is the digital form of money that is most used by the public. Commercial bank money is held in accounts at commercial banks. 3. Non-bank money is digital money held as balances at non-bank financial service providers, such as money market mutual fund shares. These firms typically conduct balance transfers on their own books using a range of technologies, including mobile apps. How many commercial banks are there in the United States? The number of commercial banks has been shrinking for years with consolidation of the industry. As of the end of 2023, there were just a tad above 4,000 commercial banks operating in the United States, and another 561 savings institutions. There are a number of reasons why the commercial bank numbers have been dwindling, including the removal of restrictions for interstate banking. The Federal Reserve observed, historically, that the McFadden Act in 1927, and other laws that attempted to address long-standing concerns about the concentration of financial activity, and worries that large banking organizations operating in multiple states could not be adequately supervised by prohibiting interstate banking. However, those restrictions began to be whittled away on interstate banking in the early 1980s, and by 1990, the Federal Reserve noted that 46 states had made changes to their state laws allowing out-of-state bank holding companies to acquire in-state banks in some circumstances. The situation led then Treasury Secretary Lloyd Bentsen to comment in 1993 that the nation effectively had an interstate banking system, but it was working under laws and regulations made for another time in America. So it was time to update the national banking law. That legislation, known as the Regal-Neal Interstate Banking and Branching Efficiency Act of 1994, removed many of the restrictions on opening bank branches across state lines, was signed into law by President Clinton. The legislation also allowed banking organizations to acquire banks in any other state under a uniform, nationwide standard. If you look around Phoenix, for example, you can trace the impact of interstate banking. The Valley National Bank in Phoenix was acquired by Bank One, which was later acquired by Chase Bank, which itself went through various consolidations in the New York and national market. Today's J.P. Morgan Chase, which was formed in December 2000, says its history dates back to 1799. This banking institution, which is the largest in the nation, includes a conglomeration of J.P. Morgan & Company, the Chase Manhattan Bank, Bank One, Manufacturers Hanover Trust Company, Chemical Bank, the First National Bank of Chicago, National Bank of Detroit, the Bear Stearns Companies, Robert Fleming Holdings, Cazenove Group, and the business operations acquired in the Washington Mutual transaction. That one bank alone exemplifies the consolidation of the banking industry since the 1994 law was passed. Okay, now that we discussed the types of financial institutions and the consolidation of the commercial banking industry, let's turn our attention to how a bank works. One of the best succinct definitions that I have seen was used in congressional testimony and told Congress that banking is fundamentally defined as the business of transforming savings into investment in our economy, while simultaneously acting as the nation's payment system. Traditionally, we think of this activity in the context of conventional banks, which issue deposits and then turn them into loans. Technically, this activity is called maturity, liquidity, and quality transformation. Simply put, this means that banks transform their deposit base into loans that are of longer maturity, less liquid, and lower credit quality than their liabilities. This process earns banks profits. So, the two key takeaways here are that 1. Banks transform savings into investment, and 2. Bank deposits are transformed into loans with longer maturity, less liquid, and lower credit quality than their deposits, which are the bank's liabilities. For example, you saved $1,000 from your earnings and deposit that into your local bank account. In turn, the bank rolls that $1,000 along with other deposits into someone's mortgage loan. Your initial deposit was quite liquid, but the mortgage is long in duration, not very liquid, in and of itself, and of lower credit quality by virtue of the fact that there is risk in making loans. Why do some banks fail? Or, more specifically, how does a bank become insolvent? A bank must match its assets, which are its loans, to its liabilities, which are its deposits, plus net worth, which represents bank capital, considering day-to-day cash flow requirements of its customers. However, if the value of a bank's assets falls below the value of its liabilities plus net worth, then a bank becomes insolvent. There are two types of bank insolvency. 1. A solvency crisis. And 2. A liquidity crisis. A solvency crisis is when large numbers of customers default on their loans, such as during the 2007 to 2008 financial crisis, causing a bank's assets to be less than its liabilities. Capital requirements in the banking system are generally viewed as the backstop for loan defaults. A liquidity crisis occurs when a bank is unable to meet the demand for its liabilities, that is, withdrawals, even if the bank's assets are greater than its liabilities and net worth. A bank facing a liquidity crisis may try to sell some of its loan portfolio. But if investors require a lower price to purchase those loans, then the value received will be below the book value of the loans. Or a bank may be forced to sell off its other assets at a fire sale to raise funds, such as what Silicon Valley Bank did in 2023. On March 8, 2023, Silicon Valley Bank lost $1.8 billion on the sale of about $21 billion in securities to offset its withdrawals. Reserve requirements, which no longer exist in the United States, generally have been viewed as the backstop against sudden withdrawals. There is one additional function of a financial system that we need to discuss. Why are payment systems important? Payment systems can be set up by a central bank or a group of banks working together through a Visa or MasterCard, for example, to process financial transactions. Domestic and international payment networks are vital to promote development, support financial stability, and help expand financial inclusion, according to the World Bank. Why is the non-bank financial intermediation or NBFI sector important? Recall from slide 26 that we noted that contractual and investment institutions have become known as the non-bank financial intermediation sector, which has been dubbed the shadow banking sector. Shadow banking describes a large segment of financial intermediation that is outside the balance sheets of regulated commercial banks and other depository institutions. Shadow banking funding includes commercial paper and other short-term borrowing, bankers' acceptances, repo, net securities loaned, liabilities of asset-backed securities issuers, and money market mutual fund assets. The non-bank sector acts like a commercial bank, except that it is not backed by a central bank or public sector credit guarantee. For some perspective on the history of this sector's growth, an article in the Financial Times, on April 22, 2024, by Hugh Van Steenis, who is the vice chair and partner of the risk advisory service Oliver Wyman in London, aptly suggested that bank disintermediation, that is the shift of lending to the non-bank financial intermediation sector, has occurred in waves. Let me read to you what he wrote in that article. He asked, "What can we learn from the history of bank disintermediation?" First, it typically takes at least 2 to 3 years for weakened banks to get over large interest rate shocks. While major banks are back on their skis, regional banks will take longer to get the rates of interest on their assets and liabilities back in balance. Lending by U.S. regional banks remains anemic, providing opportunities for private credit to fill the gap. Secondly, outdated financial regulations often exacerbate such shocks. In the 1970s and 1980s, Regulation Q, which imposed ceilings on interest rates offered to depositors in the U.S., exacerbated deposit flight to money market funds. Similarly, the Fed's overnight reverse repo facility triggered deposit flight as the Fed raised rates. Old rules are revised slowly. Reg Q was introduced in 1933, disadvantaging banks. Third, financial product innovation is a vital enabler. Money market mutual funds, introduced in the U.S. in 1971, facilitated disintermediation by letting savers invest in a diverse range of instruments. Today, new private credit structures are giving investors access to assets previously confined to banks' balance sheets, such as equipment finance. Fourth, new regulation aimed at addressing banks' vulnerabilities can inadvertently push even more lending elsewhere. While new Fed proposals to increase bank capital, dubbed the Basel Endgame, are being recalibrated, further adjustments to liquidity, capital rules and risk management practices are nonetheless likely. Specialty finance lending looks a promising new seam for private credit companies to mine. One attraction of this market, worth $5.5 trillion in the U.S. alone based on Oliver Wyman estimates and which includes equipment leases, trade finance and royalty agreements, is greater diversification and the specialist skills required. Private credit has less than 5% of these types of loans, mostly packaged for insurers. Furthermore, infrastructure loans, commercial real estate and mortgages each offer potential rich pickings, expanding the potential market to $26 trillion in the U.S. All in, this could boost the 15% annual growth expected in the private credit market over the next 5 years. Though much of course depends on bank regulators' next moves. But the need to secure access to these new asset classes explains why private credit players are changing tack, looking to partner with banks rather than be their adversaries. This year at least 6 partnerships with major banks have been signed, most recently Barclays with Blackstone. Half of these have focused on opportunities in asset-backed financing. What we are seeing is the retrenching of the banking system, where banks parcel the riskiest slice to private credit, providing less risky lending themselves. Private credit could be the Ozempic to help banks on yet another diet. Unquote. I know that excerpt from the article was long, but I hope it helps to explain the reason for the expansion of the shadow banking sector in the United States and globally. It also highlights a future risk coming from the shadow banking sector. Why do we care about the non-bank financial intermediation sector or shadow banking? The U.S. shadow banking sector has grown dramatically and currently is larger than traditional banking. It has played a critical negative role in the financial crisis of 2008 to 2009. It has major implications for monetary policy transmission. It is argued that it makes the financial system more efficient, but also more unstable. And, the sector has grown internationally as well and accounts for nearly half of global financial assets. An article in The Banker magazine on March 27, 2024, noted that financial regulators are struggling to assess shadow bank contagion risk to the broader financial system, because of a lack of data is obscuring the true systemic danger. So, the sector is big, important, and risky, because it does not have a backstop of the lender of last resort that commercial banks have in the Fed or the depositor protections from the FDIC, for example. What are some examples of firms represented in the shadow banking sector? One U.S. example of a firm that is part of the non-bank financial intermediation sector is Rocket Mortgage, formerly Quicken Loans, and is America's largest mortgage lender. That company reported it originated $351.2 billion of mortgages in 2021, which represented about 39% of all mortgages funded, according to the Mortgage Bankers Association. Some other examples of NBFI firms include the California State Teachers Retirement System, BlackRock Capital Investment Corporation, Blackstone Incorporated, American Honda Finance Corporation, GE Capital U.S. Holdings Incorporated, Brookfield U.S. Holdings Incorporated, and KKR & Company Incorporated. One of the nascent developments from central banks around the globe is its interest to develop a central bank digital currency. But what is a central bank digital currency? Central bank digital currency is a digital or electronic version of cash. There is no one format for a CBDC. It could take the form of a state-endorsed token on a blockchain, cryptocurrency, or an account directly held at a central bank, which would be available to both individuals and firms for retail payments. It is a work in progress. Some central banks are ahead of others, but the Federal Reserve is just studying how to implement such as a digital currency, if Congress authorizes it. The current statement from the Federal Reserve is that it has made no decisions on whether to pursue or implement a central bank digital currency, or CBDC. We have been exploring the potential benefits and risks of CBDCs from a variety of angles, including through technological research and experimentation. Our key focus is on whether and how a CBDC could improve on an already safe and efficient U.S. domestic payment system. In 2021, Congressman Bill Foster introduced legislation H.R. 2211, entitled, Central Bank Digital Currency Study Act of 2021. The legislation was referred to the House Financial Services Committee, but no action was taken on the study. Moreover, on July 27, 2023, the U.S. House of Representatives passed a resolution, which was House Resolution 629, that said, quote, "Resolved, that it is the sense of the House of Representatives, that the Board of Governors of the Federal Reserve System and the Federal Open Market Committee should not be permitted to develop, create, or implement a central bank digital currency, or use any such tool to implement monetary policy." Unquote. A central bank digital currency for the U.S. is unlikely to move ahead without political support. Let's now turn to the ingredient needed to create money, or more precisely create lending, through the banking system. What is meant by fractional reserve banking? This is the practice of holding only a portion of deposits and lending on the rest, which was first used as a banking practice in Sweden in 1668, when its central bank was given the authority to regulate commercial banks, and to set reserve requirements, which are the share of deposits that must be held. We will see that this practice is ultimately a multiplier of money. But first let's look at the holdback or required reserves portion of deposits. What is the history of a banking reserve requirement in the United States? In 1863, Congress passed the National Bank Act, which established a reserve requirement to ensure liquidity was on hand to satisfy customers' cash demands. The law required banks at all times have on hand, in lawful money of the United States, an amount of money equal to at least 25% of the aggregate amount of its outstanding notes of circulation and its deposits. So the idea of requiring financial institutions to hold precautionary reserves has been around in various forms for many years. But with the modern central bank and the Federal Reserve, in particular, this monetary policy tool is a way to ensure an institution can meet day-to-day cash flow needs. Although the simplest form of a reserve requirement is a set percentage of total reserves, such as required in that 1863 law, most forms are a bit more complex. Moreover, an OECD study found that there are 4 types of reserve requirements used. 1. Reserve requirement by maturity, where a country will set a higher reserve against short-term liabilities than longer-term savings deposits. 2. Reserve requirement by type of liability, where a country will segment non-bank liabilities from deposits, and have a higher reserve for non-bank liabilities. 3. Reserve requirement by currency of liabilities, where a country may impose a higher reserve on foreign currency liabilities than on domestic liabilities. 4. Reserve requirement based on residency of counterparty, where there may be a higher reserve on liabilities from non-residents than residents. Reserve requirements, therefore, can be customized based on the country's financial system. The International Monetary Fund notes that the reason central banks impose reserve requirements is aligned with modern-day central bank mandates of maintaining price and financial stability. This graphic from the IMF offers that perspective on that twofold role a reserve requirement plays. One aspect is termed prudential practice to maintain financial stability, which is an approach that incorporates practices to avoid risks in the financial system, both micro and macro. That is, the reserve requirement use helps to ensure what is termed a micro-prudential practice for a single financial institution, and to simultaneously ensure a macro-prudential practice for the entire financial system of a country. The second role of the reserve requirement is to impact bank lending, and, in turn, the money supply and economic activity, which is its monetary policy role. Is a reserve requirement the only way to ensure day-to-day transaction liquidity in the banking system? Well, the answer to that question is no. Some countries, such as Mexico, Canada, the United Kingdom, Australia, Sweden, and New Zealand do not impose reserve requirements on their banking systems. Instead, lending in those countries is constrained by capital requirements. In 2020, The Federal Reserve Board reduced its 10% reserve requirement on large deposits at U.S. banks to zero. Consequently, the U.S. is not using the reserve requirement any longer. The Federal Reserve Board may not reinstitute that reserve requirement, instead relying on the discretion of the banking institution to hold excess reserves at the Fed, which, as of 2008, the Fed is permitted to pay interest on those reserves, as a safety measure in the event of massive cash withdrawals by customers, due to some crisis or period of economic uncertainty. However, some central banks use the reserve requirement as part of their implementation of monetary policy. For example, the Swiss National Bank, which is Switzerland's central bank, increased its minimum reserve requirements for its domestic banks, raising the minimum reserve ratio to 4%, from the previous 2.5% on July 1, 2024. Nonetheless, since the global financial crisis of 2007 to 2009, bank liquidity management practices have been shaped importantly by the liquidity coverage ratio requirement. In the wake of that crisis, international financial regulators sought to improve the resiliency of the financial system by incorporating liquidity requirements into the international Basel III framework for enhanced regulation of banking institutions. Basel III is a comprehensive set of bank reform measures developed by the Basel Committee on Banking Supervision to strengthen the regulation, supervision, and risk management of the banking sector. Key liquidity measures of the Basel Committee are the Liquidity Coverage Ratio, LCR, and the Net Stable Funding Ratio, NSFR. By the way, on its 50th anniversary, in early 2024, the Basel Committee has been described as starting as a humble forum for G7 bank supervisors to become a titan among global financial standard-setting bodies. The key difference between the reserve requirement and the coverage ratios is subtle, but the reserve requirement reserves set a minimum specific amount of high-quality and liquid assets, or a holdback, against deposit outflows, while the coverage ratio reserves are based on the composition of liabilities. Said differently, a reserve requirement requires uncommitted assets as a cushion for liquidity, but the LCR and NSFR address the composition of bank assets. However, the effectiveness of either the fractional reserve requirement or the liquidity coverage ratios may be debatable, since some economic research suggested banks are unwilling to tap into their liquidity reserves when they need them, which diminishes its purpose, simply not to trigger additional oversight by the financial regulators. Moreover, these banking requirements are not foolproof to ensure sufficient liquidity under all circumstances, and banks can still fail for reasons we discussed earlier. If you want to explore what has been offered as a foolproof way to prevent bank runs, read question 320 on the Chicago Plan. Before moving ahead, let's explore those coverage ratios a bit more, as an alternative to using a reserve requirement before looking at the effect of reserve holdbacks on the economy. But keep in mind that the amount of bank reserves at a financial institution can be an institution's choice, or it can be a legal requirement, or a mix of both. Moreover, since those reserves that serve as that liquidity buffer are not loaned out or of short maturity, which means that there is a fraction of deposits that will limit the expansion of the money supply. We will discuss this point further shortly. How does the liquidity coverage ratio work? The formula for the calculation of it is shown on the lower right-hand side of the slide. The denominator is the net cash outflows over 30 days in a hypothetical scenario of market stress where creditors are withdrawing funds, and the numerator is the value of high-quality liquid assets that could be used to quickly offset those outflows. While we will not get too deep into this, take a look at those calculations for J.P. Morgan and for Goldman Sachs. These are examples of the requirement to ensure that the ratio is greater than or equal to 100%. In these cases, both financial institutions were above that minimum requirement. How does the net stable funding ratio work? This Basel III liquidity requirement takes a longer view over a one-year period by requiring banks to fund their activities with sufficiently stable sources of funding. Again, we will not get into the weeds of this metric, But think of both the LCR and the NSFR as requirements for banks to prepare for liquidity needs up to a year ahead. These liquidity requirements are important, but calculations of these measures can be difficult to pin down precisely for investors and depositors, if not routinely reported by regulators or the financial institution itself. For example, an analysis of the Silicon Valley Bank's liquidity coverage ratio as of December 31, 2022 was estimated to be 150% by the Bank Policy Institute, a trade group, which calculated high-quality liquid assets of the failed bank of $52.8 billion. However, Greg Feldberg from the Yale School of Management calculated the bank's high-quality liquid assets were $52.9 billion at the end of 2022, about the same as BPI, but net cash flow of $71.0 billion, for a liquidity coverage ratio of 75%. Which was correct? It turns out neither. The Federal Reserve report issued on April 28, 2023, found that the LCR was 103.1% at the end of 2022 and remained in that range through the end of February 2023. However, Silicon Valley Bank was not subject to the LCR until it crossed the $50 billion threshold in average weighted short-term wholesale funding in December 2022. More importantly, even with a LCR above 100%, the liquidity access that Silicon Valley Bank had was woefully inadequate for its outflow. So there may still be a place for the reserve requirement in addition to the LCR and NSFR. The last few slides we discussed focused your attention on the holdback reserves, or what was considered required reserves, which have high liquidity. But what does that have to do with the money supply? This leads us to the question: what is the maximum amount of money that can be created by a fractional reserve banking system? The maximum amount of money that could be generated by the lending process is what is known as the money multiplier, which is determined as 1 over what might be considered the effective reserve requirement ratio. By the effective reserve requirement I mean the percentage of bank liabilities that are not loaned out intentionally by the banks or by law. If the reserve requirement share was 10% of deposits, that would imply the maximum increase in the money supply would be 10 times the original deposit, that is, 1 divided by 0.10 equals 10. If, however, the reserve requirement is set at 0, then the theoretical maximum expansion of the money supply would be infinite, that is, 1 divided by 0 is infinity. However, other prudent and legal constraints ensure that loan expansion is not infinite. What if the reserve requirement was 100%? What would that imply about money creation? Would banks need the LCR and NSFR requirement? What do you think? How does the banking system create money? Remember that banks want to lend out as much as possible for its profits. The starting point to understand the process of how the banking system creates money through its lending. Remember that the creation of a demand deposit is by definition included in the narrow concept of money, M1. Initially, consider the financial account, or T account, of a bank's balance sheet. As is true for all businesses, assets will equal liabilities and net worth. A customer's deposit at a bank is a liability of the bank, since it is owed to the customer, generates a reserve on the bank's balance sheet as an asset. Those reserves get loaned out, which is how the bank earns money. One bank loan then becomes another bank demand deposit, which continues to cascade through the banking system with an increasingly smaller ripple effect. If reserve requirements exist effectively, then the monetary expansion is limited by the money multiplier. However, without a reserve requirement the process can continue. But even aside from a customer deposit, a commercial bank loan to a customer will create a demand deposit for the customer, which creates money. Now you might be wondering whether an individual bank creates money, whether it is the banking system that does it, or is it the central bank? There is widespread agreement that lending creates money. But there are 3 views on how that happens. 1. The credit creation theory says, that each bank individually can create money simply by the act of lending. Economists holding this view include Schumpeter, Wicksell, Tobin, and others. The implication of this theory is that any loan, credit creation, by any individual bank can add to the money supply. 2. The fractional reserve theory argues. The banking system collectively creates money through the money multiplier concept. It is espoused by Hayek, Stiglitz, Samuelson, and others. The implication of this view is that any loan by the banking system can add to the money supply. 3. The last view jettisons the idea that banks can create money. The financial intermediation theory says, banks are only financial intermediaries, no different than non-bank financial institutions, and borrow short-term and lend long-term. In this view, banks are unable to create money. Economists holding this view include Keynes, Mises, Bernanke, and Gertler, Gurley and Shaw, and others. This view implies that only federal debt monetization where the central bank buys the government debt can add to the money supply. Which is correct? Well, today's popular textbook view seems to be that the fractional reserve is the reason why the banking system creates money, but let's consider that hypothesis further. The Bank of England addressed the money creation issue in its quarterly bulletin in 2014. The published article said, "In the modern economy, most money takes the form of bank deposits. But how those bank deposits are created is often misunderstood. The principal way is through commercial banks making loans. Whenever a bank makes a loan, it simultaneously creates a matching deposit in the borrower's bank account, thereby creating new money. The reality of how money is created today differs from the description found in some economics textbooks. Rather than banks receiving deposits when households save and then lending them out, bank lending creates deposits. In normal times, the central bank does not fix the amount of money in circulation, nor is central bank money multiplied up into more loans and deposits. Although commercial banks create money through lending, they cannot do so freely without limit. Banks are limited in how much they can lend if they are to remain profitable in a competitive banking system. It seems to me that the BOE holds the credit creation theory of money. Let's wrap up this discussion of money creation with some accounting to show the process of money creation. The starting point for this money creation begins with a bank deposit. In this example, it is assumed that the First Bank of the People or FBP receives a $10 million deposit, which is shown in Step 1, as a liability and as an asset of the bank. Assuming there is no reserve requirement on bank lending, then the bank management will decide how much of that reserve will be loaned. In Step 2, FBP decides to loan $7 million of that deposit to Business 1. In turn, that cuts FBP's reserves by that amount to $3 million. Then, for simplicity, assume that Business 1, which received the loan, deposits it into its checking account, that is a demand deposit, at the Bank of the Nation's Business or BNB, which increases BNB's deposits and reserves by that $7 million, which is shown in Step 3. Next, assume that BNB decides to loan out $2 million to Business 2 of that new deposit it received, Step 4. Now, assume that Business 2 deposits that loan in its bank, Bank of All Business, BAB, which adds $2 million to BAB's assets and liabilities. Finally, assume that BAB decides to loan out $1 million of that incremental deposit on its balance sheet to Business 3, which deposits the loan into its bank FBP, Step 6. Although this process could go on, this should be sufficient to show the impact on the money supply. Initially, that $10 million demand deposit adds directly to the narrow measure of the money supply. But then each successive loan creates additional demand deposits, which in turn adds incrementally to the money supply. Then after these three loans, that initial $10 million deposit expanded the money supply cumulatively by twice the initial deposit to $20 million. This is the power of fractional reserves. One caveat. Even though for clarity, this example assumed a deposit to start the process, and multiple banks to cascade the lending process and money creation, It does not have to be portrayed that way. It could be, as the Bank of England noted, that the commercial bank starts the process based on its net worth, that is its bank capital, without the need for an initial external deposit to make a loan. Moreover, there is no reason to have multiple banks, other than the clarity in the example. All of the lending process could be executed within a single bank over some time horizon. With this final example, we have concluded Lecture 9. Take a moment to think about these questions.